Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I want to talk about gold. This is an asset class I find particularly fascinating because it is part of a relatively rare group of asset classes that does not offer any sort of yield. As I've said before, this means prices have had to rise for gold to just keep up with a low-yielding fixed deposit. This hasn't helped investors back from holding the precious metal, of course, and for anyone interested in the long history of this asset class, I'd recommend a read of The Power of Gold by Bernstein. I particularly like the subtitle, which is A History of an Obsession, which I thought was a particularly good way to put it. Now, if you read the book before, drop me a message on LinkedIn and let me know what you thought, or if you thought there was a better read out there. Now, this view notwithstanding, 2022 has been anything but a usual year in financial markets. Gold, of course, has been a standout performer. And the key question confronting us today is whether prices will rise sustainably above $2,000 an ounce. Now, before we answer that from a short-term perspective, a little bit of longer-term context. First is that gold is often viewed as an inflation hedge. However, we'd prefer to say instead that gold is driven by real or net of inflation bond yields for a couple of reasons. First, this captures the inflation relationship. If bond yields are unchanged and inflation rises, the real bond yield falls and gold prices tend to rise. That's the inflation hedge argument. Second, of course, this captures the potential yield you're giving up by investing in gold. So it makes sense that gold goes up when real yields go down and vice versa. Now, second, of course, gold can also trade inversely with US dollars. Similar to other major commodities which are denominated in dollars, a strong currency can mean weaker gold and vice versa. Finally, gold can be a hedge against short-term equity market volatility. This tends to be a more short-term phenomena, but we've seen it in action earlier this year with gold jumping when equities dropped sharply. Today, gold continues to push up against the $2,000 level, and the key question for us is whether gold firmly breaks above this level and continues to rally further. We believe it can. Last night, gold rallied to $19.98, just $2 shy of the $2,000 level before pulling back. However, many technical indicators remain bullish following its earlier break above 1965, so we do expect another run towards $2,000 in the coming days. Technical resistance above $2,000 is relatively light, so a firm break above this level is likely to mean the metal gathers momentum to subsequently test its previous high around $2,070. Key support, of course, sits around 1950 to 1965, which are levels we expect will limit any pullbacks. We have in fact just opened a new trade idea on gold specifically around this view, targeting a move towards $2,057. So please do have a read of our daily FX Navigator for more details on this, including subsequent technical support and resistance levels on gold. So one trade idea, I think that looks interesting today, but we'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.